This one stock will outperform actively managed accounts, investing companies, your coworker that swears he's a stock market genius, and Wall Street bets. To truly understand this stock, you must understand it's actually a single stock, but a collection of multiple stocks to make up an index, which tracks the market over time. The stock I'm talking about, which actually is an index of course, is no other than the S&P 500. You might have heard about the S&P before, but do you know anything about it? What companies are within the index and what does it take to enter this elite group of at least 500 stocks? Is the S&P 500 actually a safe place to invest into, or has the media and influencers of today been giving unfavorable advice? Hey, I'm Stannis, and I help people wanting to be financially free by giving information on financial topics and some personal information so you guys can see my own growth and verify that I take my own advice. The origins of the S&P 500 begins with a company called Poor, which was founded back in 1860 by Henry Varnum Poor. Poor wrote about the history of the railroad and potential future implications it could have in America. He was able to gain insight on the railroad due to being appointed commissioner of the Union Pacific Railroad. With his insight, he was able to inform other people about the railroad and thereby help investors be informed on the railroad. So basically, this guy had the inside scoop on the railroad and sold his information to investors. Pretty baller. Standard Statistics and Poor eventually merged to become Standard & Poor, which is a creator of financial market information, which is nowadays used by many investors as a measuring tool and a source of knowledge to invest into other companies. And they are an issuer of credit ratings for companies and debt obligations. The S&P 500 was initially an index of 233 companies in 1923. And it was not until 1957 that it grew to involve 500 individual companies. Today, the S&P 500 index is a weighted market cap index of 500 leading publicly trading companies in the U.S. Now that we have a rough understanding of the initial beginnings of the S&P 500, let's take a look into what it actually takes to make it into the index and what type of restrictions are there that are keeping your favorite stock out of it. To even begin this journey of your company making it into the index, it must originally be from the U.S., so if you want to be diversified into other countries, you would have to do it separately since the S&P 500 only holds American companies. The market cap for the company must be at least $8.2 billion, which means that it can include the higher market caps of the mid caps, and any large cap would be eligible for this requirement. The S&P does not include smaller micro cap companies, which potentially can see more growth than the already established companies. If you want to invest into small companies, then once again, you would have to invest into some other stock or index. This market cap minimum does help the index from seeing too much volatility that can be seen on smaller market cap companies, giving the extra layer of safety for its investors. The third requirement is that the stock market must be highly liquid, which means that a company has the ability to pay debt obligations or current liabilities without having to raise external capital or take out loans. Alright, that's cool information all, but how does that company control this? Well, to be more clear, the company cannot necessarily control it, but the market can. If market liquidity is high for a particular stock, that means it's usually easy to buy or sell. It means it's easy to buy or sell it without causing a large change in price. If market liquidity is low, the opposite can be true, so buying and selling can have a significant impact on the asset's price. You can also determine this by saying the volume traded in a day for a particular stock. The fourth requirement is that at least 50% of its outstanding shares must be available for public trading. Lastly, the company must report positive earnings in the most recent quarter, and the sum of its earnings for the previous 4 quarters must be positive. This is another big filter for companies because it requires them to be profitable. This will exclude the non-profitable stocks, thereby reducing risk in the index. With all these restrictions in place, about 27 companies will be added or dropped each year. So if you're an individual stockholder and you know that your stock is in here, it's important to keep an eye on its performance, and if it does end up meeting the S&P 500 requirements and gets kicked out, then you should be aware of possible downtrend or sell off of that stock. The index holds an array of different companies in its holdings, some of which are popular like Apple, Microsoft, Amazon, Berkshire Hathaway, Alphabet, Johnson & Johnson, Exxon, and Meta. Although some might be popular, there are also not as well-known stocks like West Rock Company or KeyCorp. Nonetheless, these companies have met the requirements and are awarded entry into the index. Do keep in mind that the index does not have equally divided allocations to each stock, so the index allocates more to some stocks than others. For example, Apple is 7.1% of the index, which makes up a big chunk of an index of 500 companies. So if you are more inclined to invest in individual stocks, you might look at numbers like these and determine if it's a safe stock. Most individual investors will have the top companies in their portfolio, but disregard the companies which do not have much of a holding or interest in the public eye or within the index. Although you are reducing your diversification of your account, which means you'll reduce some stability, this also will allow you to focus more money into stocks that will yield a higher return. Now that we understand how a company gets added, we are able to buy into stocks or look out for stocks that may potentially be added to the index. But does a stock being added to the index mean that we will see a price increase in the value of the company? Well, if you ask me, it would seem likely that it would, since a bunch of people who were not investing in it before are now allocating a small portion to that company. But let's take a deeper look to see if we can find a concrete answer. Generally, the stock will see a price increase on the news of it being added, then decrease back to its original value, or just above its last price. This increased price is mostly built up on some hype for the company, and people buying the rumor and then selling the news, which then causes that little decrease back to the original price. Over the long term, if the stock does continue to be in the S&P 500, then it could definitely continue to see more growth, but the success will be mostly the company's doings, not the fact that it's in the index. S&P 500 has returned 9.6% per year on average over the last 20 years with dividends reinvested. That return adjusted for inflation is 6.9%. This return of 9.6% is what all the investors strive to beat, and most end up failing, and those who do beat the index most likely spend more time researching than the index investor. Now, with this time spent on researching instead of doing other income-bringing activities, we need to ask ourselves if the time commitment is worth it to possibly see a higher return, or would your time be better off trying to learn a new skill? A 10% return is pretty good, but it's not something that will change your life, especially if you only have a couple $1,000s. Investing into the stock market can be full of gratification once you start to become profitable and you continually make money, but the day you begin losing money and still continue to invest into assets that depreciate faster than just holding money, the difficulty of continuing your process will increase. For the most part, you are not able to switch your scenario around rapidly, and you are left with the option of waiting or selling at a loss. Waiting and giving time for your investments must be understood, and if you only wish to make quick money, then you'll soon find out that your luck will run out. As an investor that invests into the stock market, you're going to have to realize that there will be unforeseen events that completely change the outlook of the future in the short term. But if you only invest what you are able to and stick in the market longer than a couple of years, then you can most likely achieve a modest return. It's quite often that you see the stock gurus or advanced traders making an avalanche worth of money and living the life of rock stars, but it's important to understand that a huge portion of their money does not necessarily come from trading or stocks, but it does come from the courses or knowledge they sell to others who want to make money off the market, just like the guru. Chances are investing into index funds will not make you rich. It's easy to see why too. Generally, you need to do actions most are not willing to do, or actions that people cannot easily replicate to make a large amount of money. When you are investing into indexes, you fail to separate yourself from the majority. The main difference between you and others is that you are capable of saving and achieving a higher than normal return on your money than from the bank. Indexes will help you protect your money from inflation most of the time, and they will give you a higher return than other savings accounts or entities where you can store your money. Overall, indexes are not a bad way to invest, and the S&P 500 is one of the Overall, indexes are not a bad way to invest, and the S&P 500 is one of my personal favorites in the index market. But understand that this will not make you rich overnight, but will help you appreciate some of the savings over the years. As for me, guys, I do own VOO on Robinhood, which is the Vanguard S&P 500 ETF. I only have around $800 invested into it, and I do not regularly invest into it, but I do like to have just a little in my portfolio to help me diversify my pretty aggressive account. If you have learned something from this video about the S&P 500, then go ahead, let me know in the comment section, and if you found this information valuable, leave a like and subscribe to see more in the coming future. Peace.